The AI trade has officially entered its most turbulent phase yet. Liquidity cracks, surging leverage, and a CapEx arms race that's outpacing even the strongest balance sheets. It's all reshaping the technology landscape. And while markets remain just a few points from all-time highs, the stress factors are no longer subtle. Today, we're joined by Krishna Kumar of Goose Capital to break down what's happening beneath the surface, why credit is flashing red, and what investors need to do now to protect capital and stay ahead of the next phase of the AI revolution. Welcome to The Money Runner. I'm David Nelson. Krishna, welcome to The Money Runner. Thanks so much for being with us today.
Thanks, David. Thanks for having on your show. Big fan of your show and really happy to be on it today.
Wow, thanks very much. Just for context, people, we're recording this Monday night, and obviously a pretty big significant rebound in technology shares today. And I guess, Krishna, what I really want to hone in on here, does that really change the backdrop from what's been building for the better part of the month? Or do we throw discipline aside and just pile back into all these high beta names?
I think it's a tough one because I think we're at a point in the market where the bulls are not quite there yet in terms of where the price needs to get for them to feel comfortable, and the bears are not sure whether to reshort it. So if you look at the decline from the highs, we've kind of retrace back to the 50% Fibonacci level today. And we try to close about a 50-day, which, would obviously be a very positive thing. So from a pure technical perspective, we're kind of in no man's land. But the bigger picture question to ask is, where do we set up for Q1, right? Like, obviously, the next 4 weeks, we have the seasonals are very strong, and the markets tend to outperform. If you look at the quarterly performance of the S&P 500, the Q4 performance is much, much bigger than Q1 through Q3. So there's all the seasonal factors that one could say would be a positive catalyst.
So it says Santa Claus isn't dead yet. He's at least trying to make a comeback on that. But what scares me, what bothers me is generally when I see risk assets, when I see big price swings, and I mean we've seen some really big price swings in some stocks. Usually, sometimes the performance spread is 20%, up and down. Sometimes that's indicative of at least a change in something. It doesn't mean the end of a bull market, but it seems something's happening here.
Yeah, I know. I have this sort of general view that a typical stock, tends to have a 50% move in a year. So if you take any random stock like Google, from low to high, you get about a 50% move. And the question is, which part of that, are we at, right, in the particular stock? So if you take Google, for instance, a good example, because it's been in the news the last week or so. Earlier this year, the narrative on Google was they're going to lose search because there's all these other companies coming up with search engines that are AI-driven search. If you think about AI, so far, what we have with the LLMs is just a better search engine. Right, we're able to search for documents, search for information, and get more precise answers. And so people thought, okay, Google was going to get disintermediated, and OpenAI would be the go-to place when I have to do something. And so Google underperformed dramatically. And then, lo and behold, they released this Gemini 3 model, the Nano Banana version. And then the next thing you know, the stock goes bananas, right? So if you look at Google and its outperformance over the last month, I would say last couple of weeks, more importantly, you could kind of see this AI story play out. What we know, David, is that whenever we are dealing with disruptive technologies, it's very hard to pick the winners. So if you went back to 1920s and I told you there's something called a car that's just come about, there's something that people are driving around. At that time, in the early 20s, there was probably like 2,000 car companies that existed,
Was
right?
it really? Wow.
Yeah. So it's very hard for us to know that Ford Motor Company, which still exists today, was going to be the big winner. And they came up with the Model T, and then that took off. And they survived many different business and economic cycles along the way. So it's very hard to know who the real winners are going to be. What we do know is who's going to get disrupted,
You know,
right? Over one.
I want to drill down on that because there's been this fascination with the Magnificent Seven, and interestingly, when you look at guys, we're going to show up a Magnificent Seven chart, and if you look here on this chart, what's interesting, you obviously, just like you said, suddenly Alphabet is at the top, and I find interesting some perceived winners like Microsoft was going to kill it in software. We're going to be the last guy standing. And slowly but surely, it's really ceded a lot of ground. And Apple, that doesn't even have an AI story, is now suddenly climbed into third place. And suddenly today, I believe we actually have our first $1 trillion healthcare company, Eli Lilly. So it seems like the chess pieces are changing here somewhat.
Yeah, there definitely is, and we should see more disruption as we go along, because we just don't know what else can happen, right? And for instance, let's take the AI trade. So far, it's been a more of a picks and shovels play, right? So you had Nvidia and the hyperscalers, and those are the ones that have the markets bet on so far, because we can't quite see the people that are going to use this technology and potentially benefit from it, which will be, I think, all of us, right? All the consumers and most businesses will benefit from AI technology. But we don't know the clear winners, like who's going to 10x because their AI is going to make it much easier for them to do what they're doing, the margins are going to increase, and so on. That's not very obvious at this point. But we do know the AI phase is in the picks and shovels phase, right? So we're basically betting on Nvidia, betting on the hyperscalers at the moment. Now, the problem with that is Nvidia itself can be disrupted, right? So you could have Huawei or Cerebras or some other company come up with very energy efficient, inference chips, which will mean the demand for GPUs will kind of go down. It could also be disrupted if we find that we don't have enough energy to run the GPUs, right? So there's many different ways in which this can play out from here. The first obvious thing that everybody knew was, we're going to need a lot of GPUs to do this, to training these models. But what if now we've come to the point where the training of these models is so expensive, there's only like 2 or 3 companies that can actually spend the money on it, and they have their own processors and their own infrastructure and architecture. So if you take Google has its own thing called TPUs, which are kind of similar to GPUs, and so Google may not need as many GPUs. They might need it in training, but for inference, I think TPUs are much more energy efficient.
That's kind of interesting because I'm just looking at the tape today. Nvidia was up, it wasn't a bad day, but the clear winner was, maybe a chip company that could lead in inference, and that was Broadcom. That was up, certainly a lot more on there. I think those bring up interesting questions, and the winners are not clear at this point. Buffett seems to have picked a winner, and the market seems to be following his lead. If you don't mind, I want to pivot to something that I heard you talk about, and you were really one of the first to really signal it out, and that's Oracle. And I've done a fair amount of work on it, and I've looked at it. It seems to be ground zero for whatever concerns you might have about this massive CapEx cycle. And maybe there's a massive payoff in the end, but you've pointed out, even on our show here at Bell Point, some of the things that bother you. Maybe walk us through that, and maybe start with their debt structure and what you're seeing there.
Yeah, I mean, well, as we know from the the distribution of debt that's outstanding, Oracle has the most levered balance sheet, compared to all the other hyperscalers. So Oracle, if you think about it, they were not as big in the cloud services. They were more like a database company. They had other software services, but not really known for their cloud. People use Oracle Cloud, but it's not as big as, say, Azure or AWS or Google's cloud. So they try to make a play to be a cloud player by getting into these contracts obviously with Meta, but also with OpenAI and others that are training these models. Now, the issue for Oracle is that if the amount of debt that they are being forced to borrow in order to, do all the projects they've agreed to do, it's getting to be a very big number for the market to feel comfortable about. If you look at like Google or even Microsoft or even Meta, they have businesses that throw off a lot of free cash flow. And so the market doesn't seem too concerned about them. Their credit spreads have also widened. But when you look at Oracle, there's a big question mark on what happens to the, cash flow. Are they going to have the money to repay? So the CDS spreads have widened quite a bit. So during every cycle, we have something like an Oracle. So if you go back to 07, 08, there was similar, things that people started to look at, whether it was a CMBX spread or some other spread related to the zeitgeist at that time.
When you brought that up, that really rang a bell for me, because I just think as an equity investor, it seems like the worst things happen from the bond markets. It's always something there that causes the biggest concern. It isn't even a missed earnings or a missed investment cycle. It's something that happens in the fixed income markets that always seems to flag some concern. And you've honed in on an Oracle. As for the free cash flow, guys, we'll throw up a chart on this. That's going negative, and it seems to actually get worse over the next couple of years before it starts to get better. Maybe this works out for them, and maybe in the end, they'll look back and it will have been a home run bet. They took the chance. They wanted to grab the market share, and they got it. But we're talking about it, and it seems the very fact that we're talking about it means the narrative isn't going away anytime soon.
Right. I mean, I think the issue is more that if you are doing all these investments with your own cash flow, then the market loves it. They're like, oh, great, you're finding great opportunities to invest, and so we'll re-rate your stock, right? So that's what we've done with Microsoft and all these other companies. But the moment you sort of come to the bond market to borrow money, particularly when our fiscal is not in such a great position, and the government's actually going to be borrowing a lot more money next year than this year, because the tax receipts are going to be lower, the tariff income may not be as high, so you're going to get like some crowding out of corporate borrowers if the economy is in a good place. Because the economy is a good place, interest rates are not going to come down as much, and there's a lot of treasury supply that's going to come to the market. And so it becomes harder for companies to borrow money. I mean, Oracle will be able to borrow money for sure, but I don't know what spread level is the appropriate spread, given the potential risks out there with AI, and then particularly the activity they're involved in, right? So if you think about the AI stack, you have the models and all of that. And then you have the people using the models, and then the people providing the infrastructure. So the people providing the infrastructure are in the most economically sensitive part of the cycle, because they're much more driven by what's happening to the business cycle. So imagine like we went into a recession. There's a lot of job losses, and the Fed has to cut interest rates, but also the profits come down because the economy. The consumer side will soften up, and that causes things to slow down. I mean, the more sensitive part of that cycle would be the people providing the infrastructure. If I'm just a user of AI, which is most corporations, well, I can just not use much AI. I can just say, okay, I'm going to, not spend as much money on this. I'll try to, cut costs. Whereas if you're trying to provide this infrastructure, you're doing these long-term contracts, and so it'd be very difficult to know how that cycle plays out. And so there is a lot of economic risk, obviously, that comes with somebody like that.
I want to keep it there because you mentioned the Federal Reserve, and for me that brings up the idea of liquidity, and I just totally feel that you don't see moves like we saw over the last couple of weeks. Massive reversals. The trading was very early 2008 to me, almost like some hedge funds decided to take down their book and unwind some stuff, and then over the weekend, I put up a balance sheet of the Federal Reserve, and you can see this runoff of the balance sheet. I don't know what the exact number it is, but just looking at a chart, it looks somewhere between 80 and 90 billion a month, somewhere around that. But nevertheless, it's got to be less liquidity. How big a factor is that in the overall market structure? Because I'm seeing, a fair amount of price swings, especially in these like triple levered, double levered ETFs that a lot of traders are using, and that's got to accentuate, some of these downfalls.
I think the Fed's balance sheet, even as per the Fed, they're close to, the terminal level at which they want to be at, so that the system has enough liquidity for all their, operations that they do. So I think they've come to that point. So I think there's definitely some impact from the fact that they've been reducing or rolling things off rather than adding to the balance sheet. So that accommodation definitely has some role to play. But we also have to remember there's a much bigger picture going on, which is if the market reassesses whether the AI thing's going to be profitable and whether they will have the runway to do this, right? Remember, like a lot of great businesses get built when interest rates are at very low levels. Like you look at Amazon, look at all these great companies. I mean, Amazon's a great company, has a great founder, but it also benefited from this whole period of very low interest rates where they were able to borrow money very cheaply, or the market didn't care about them paying a dividend or returning capital. And they were able to use their stock to then, acquire people, so that you could hire people, give them stock-based compensation that, in a bull market, it works in a very pro-cyclical way. So, your stock goes up, that gets, more people excited to come to work for you. And then, then you're able to use your stock to hire more people, better people, and so on, right? So I think part of that was possible because interest rates were very low. Now we have a slightly different situation. Interest rates are not, not high, but they're not low either. The Fed's cutting, but maybe they go once a quarter, maybe they go in December, and then maybe quarterly, so March and June after that. So it's not like a fast, like aggressive cutting going on. And then on the flip side, if you are borrowing money, you have to pay some spread on top of treasuries. And so your cost of capital has gone up quite a bit. So I think it's partly a cost of capital story. We've had the lowest cost of capital in the world for the longest time, partly because of our financial markets, partly because of central bank policy, partly because of fiscal policy as well. Now, we may not have that situation anymore. So you look at Europe and Japan, they have much lower interest rates than we do. Even countries like Greece, where, 10 years ago, or 12 years ago, you would have been panicking about Greece. Greece, 2-year Greek yields were in the double digits, right? And now we're running to give them money. And the same thing in most of Europe, right? So the market has reassessed the US balance sheet as a whole. And then so companies are having to pay more to borrow money, right? And this is not something that will get solved overnight. It'll take time because obviously we'll need to see inflation's coming down, fiscal policy is more neutral, not very aggressive, and we have to see the impact of the tariffs. And we don't really know yet what's going to happen with that.
Let's pivot for a moment because I want to go to your firm, Goose Hollow Capital Management, and as investors, we often get caught up in the heat of the moment, what the latest trend is, and certainly AI is, of course, the important trend and has been for a couple of years. And we almost don't think of it as investors, like the full, what I would call market cycle. How do you do through both the bull, the bear market, and then back to the bull market? And that's something that you and your firm really focus on. It's about the ride, and roller coasters are fun. I get it, but they're really only fun for certain periods of time. When you're in that bull market phase, it's great. But when things turn around for whatever the reason, and you start to go into a sustained downturn, and they come eventually, they happen. All right, you seem to navigate that pretty well. Maybe set the backdrop for how you guys approach the market, and what we should look to in some of your funds and how you position yourselves.
Yeah, no, this is a great segue into our products, David. I mean, we have a tactical fund that goes anywhere type fund, which has a pretty, we've given ourselves the luxury of going across the world, going across the capital structure. Sometimes we also have some commodity bets and currency bets wherever we see the opportunity is best. It comes with both pros and cons. Because we're always disappointed with our performance because there's always some market that has done really well that we did not have enough of, or we missed, or when you're like a long large cap US equity guy, you only have the S&P 500 to beat you up with. But when you're like us, we're looking at every possible market on the planet. There is always some place where there's a big bull market happening. So this year it was Korea. We had Korea earlier this year. We sort of, after the tariff debacle in April, we reduced a bit of our Korea exposure, and that turned out to be a big mistake. But the problem we have in the product is mostly that the opportunity set is so big that we're always kind of trying to optimize around that. But coming back to what you were saying, so I think it's very important to think about two things as an investor, right? So obviously the first one is that, as Warren Buffett said, don't lose money. And rule number two, don't forget rule number one, right? So it's like you need to sort of ensure that you're preserving capital in these bear markets. In the ETF format, it's a little more tricky to short things. There are rules around shorting things in the ETF, and we're not like a levered fund. We're a fund that's open to anybody. So we try to keep to those rules, and so that makes it a little more tricky to completely immunize the portfolio. But we try, and so the first thing is that you have to obviously ask the question, like, what can go wrong? Because what can go right will automatically happen when and you've kind of managed the downside a little bit. The upside kind of takes care of itself in some sense. The second thing is that, as you correctly pointed out, there is a cycle. There's a capital cycle, there's a credit cycle, there's a business cycle, and an investment cycle as well. So we might have just gone through a big AI cycle. The first part of it was betting on these hyperscalers and the infrastructure providers, right? So that's what we've done. The next leg is in the AI cycle could be very different, and if you take the previous big technological leaps we had, whether it's the steam engine or the telecoms boom or any of this stuff, the companies doing that don't make all the money. It's the consumer that ends up benefiting from it, and other companies that utilize the technology. So our job now is to try to understand what that looks like for the next 12 months. Is the consumer going to benefit from all of this? Is the productivity boom that people are talking about going to show up in the near term, or is it going to take a while, right? So that's
that's a great point, because I came across a chart over the weekend, and I threw it out in a note on my Substack site. And if I look at S&P 500 operating margins, they appear to be climbing, and the estimates for the next couple of years are even much higher. there's no hard evidence that I could find that it's AI related, but it's coming from somewhere. Any thoughts there?
Well, I think there's definitely. I think we're not close to peak margins, but we're not that far from peak margins in terms of like if you look at the z-score of margins historically compared to now, we're not that far from peak margins. But the key thing is that two things matter. The ROIC of the index as a whole, if you go back in time and look at like what the index was made of. I mean, the 40% of the index is Max 7 and some of these other tech companies. I mean, the beauty of having these platform businesses, like whether it's Meta or Google or Apple, these were all companies that were platform companies. They didn't take any of the risks that come with the economic cycle because Apple comes up with designs of phones, Foxconn makes them for them. They don't really need to worry about whether the phone demand, it matters at the margin, but they're not taking the warehousing risk of all these phones that they made that nobody wants to buy, right? Because the suppliers take all of that manufacturing risk. But now we're moving from that sort of very de-risked platform company composition of the index to something where these companies are taking a lot more economic risk because they're now in the business of providing cloud services and other things other infrastructure that would ultimately depend on how the economy fares in the next 12 months. So I think that's the important part, is that we've gone from platform companies with very low risk to the same companies taking a lot more risk on their balance sheets, right? So clearly, like looking at margins and all these things are helpful, but we also have to understand the business model and how that is changing, right? How is the AI going to be monetized? Are we going to use ads to monetize it? While it makes a ton of sense because Google, has been very good at monetizing ads. If OpenAI tomorrow started to show ads in ChatGPT, I don't know if people would have the same trust with ChatGPT as they do right now. So there is a whole question of how do they monetize the user base they have?
I would say you look at Alphabet, and they seem to be dispelling the fears, but they're coming out with great models. I'm just wondering, here it is. It's significantly above its 200-day moving average. It's had a home run move, but at some point in time, I got to believe that there's some cannibalization of their existing search. That doesn't seem to have happened yet. It's not showing up in its numbers. I would imagine they would have to evolve that changeover over some length of time.
Yeah, I think it's harder to show ads when you're in the AI mode, because when you're in AI mode, people are used to asking the AI and the AI responding. And if the AI then says, "Oh, by the way, you should buy this toaster oven," now that you're talking to me about toasters, I think like people would like look at it a little differently. So that there is that issue as well. The second issue is that Google serves like billions of queries a day from everyone on the planet, and it costs them nothing. I mean, it costs them a lot of money, but it's not like as expensive as say running inference for every query. Because you have a big matrix multiplication that you have to do every time you have to do an AI query, and that costs compute quite a bit. So I'm not familiar with the actual numbers, but my understanding is an order of 10 difference between, say, a regular search query and what it would cost to serve the same query in AI mode, right? So that's why they probably don't want everyone to be using AI mode, because for them to scale that also would be tricky. Like it's one thing for OpenAI, which has 700 million users or something, but how many are actively using it on any given day? It's not a lot. Whereas Google is used by a lot more people, and the number of queries they deliver is also much bigger. So it might be very expensive for them to actually deliver the compute. So I think there is all this question mark around how are they going to monetize it? Do they have the money? Do they have the energy to do all this stuff? And how are they going to monetize it? So that's the phase we're going into now. Those two questions.
Let's take it back to Goose Hollow again, because I don't want to lose this, and we're coming up on we've only got a few minutes left. You guys are truly. I can't even call you a global shop because you're not only a global shop in terms of that you look at every market, you look at almost at every asset class as well. I don't know quite how to put that in context, but that's a lot of work to be looking at all these markets. When you look at that through that broad lens that you have right now, what's the most attractive either country or asset class or investment theme that you're seeing right now?
That's a great question, David. I mean, country-wise, we are a bit neutral on the rest of the world because things have actually played out. We like the LATAM region overall, so we have some positions there, and we're looking to add there if we get an opportunity, particularly if there's some geopolitical risk there right now. So if that causes some turmoil, that would be a good opportunity to look there. So that's where we're mostly focused on. But in terms of like the portfolio itself, we are more defensively positioned. So if you ask the question, is the AI going to get built? What is needed? So assume that we have the money to do all these things. Do we have the energy? And there's a big question mark on that. So we like having some bets related to that, whether it's natural gas companies or some oil companies that are more in the oil services space, which we think we'll need to do a lot more of the old school energy technology in order to make this thing happen. Because the new stuff we're talking about, like nuclear and all that, it takes a long time to come to fruition. So we might want to build 10 nuclear reactors, but it will take us 10 years to do one of them, right? So there's a lot of permitting issues that come with it. So that's where we're focused on. And then we're also concerned with what the consumer is doing. And partly it's because of the government shutdown and a few other things, including prices of things or everyday things going up a little bit. So the consumer might be struggling a little bit. So we kind of are a little more defensively positioned on that front in the US. We like staples in particular. So we have that kind of barbell between staples and energy here. And
it's funny that you said that because just before this crack in the AI market, there was the spread between technology, consumer staples, healthcare, probably the widest I've seen on a short-term basis in a long time. It was almost like, and I thought to myself, like, we're still buying toothpaste, I'm still pulling up to the pumps. And suddenly now the narrative is flipped coming into this week. Granted, today was a big day for tech, but coming into this week, the spread between healthcare and technology, just since the start of this month, I was astonished at this, 1,600 basis points it's only a few weeks here. And I look at the 52-week high list and a lot of healthcare. I mean, Johnson & Johnson, all boring names out there. So there is another part of this economy out here that we should be looking at.
Yeah, absolutely. And also, if you think there is any risk of an AI unwind, sometimes it's easier to think about where the money is going to go. Is it going to go into cash? Is it going to go into longer duration treasuries? Is it going to go into credit markets or overseas? Or is it going to go into staples here? And I think this time around, some of this might actually go into U.S. Defensive names like staples and healthcare. We own a bit of healthcare and staples, and that's our kind of core long in the U.S. And then tactically speaking, we have a few exposures, particularly in Europe, again around energy, because we think that the energy story is much more complicated. I know that people sort of say like, oh, there's all this oil supply that can come online, and if you look at the balances for next year, it's much more tightly balanced market. But there is a risk that something happens in both in Europe and here that could cause oil prices and energy prices overall to go up quite a bit. So I think it's good. It's a good time to sort of have a little bit of exposure to that as well.
Great stuff. We're going to leave it there. Krishna, for the audience listening, there's a lot of wealth advisors out there as well. If they want to learn more about you and your team, where do they go?
Yeah, so we have a website, goosehollowcapital.com, which is where we have our information. We have, you can subscribe to our, monthly, quarterly letters that we sometimes send out. And you can also reach us directly if you have any questions on any of the products we have or anything, any other things we can help you with.
Great stuff. Krishna, thank you. Guys, that's it for this week. If you want to learn more about yours truly and the Money Runner, go to my Substack site, dcnelson123 at substack.com. Thank you, Krishna. I'm David Nelson, and this is the Money Runner.